in this video, we are looking at a short straddle and the possible adjustments that can be done to a short straddle. Okay, let's go find out what's a short straddle. In a short straddle, we are selling a call option and a put option, both at the money. They are both in the same expiry on the same instrument. If we do such kind of a transaction, that is a short straddle. The risk is unlimited on the upside and the risk is significant on the downside. Downside, it is significant because a stock can go down only up to zero. That's why it is significant. It's not unlimited to the downside. It's a non-directional view. So we do not need the stock to take a direction. Like the stock is here, for example, whatsoever it is, the price. If it is Nifty, let's say, for example, 25,000, which is here, and we are taking a view that Nifty is going to be range bound. So if it's going to be in a range, we make the maximum profit on expiry if the stock stays more or less the same where we started during the month. What we don't need Nifty to travel like that or like this or even like that or like this. We don't need this. That will create problems for us because here there is a loss making area, here there is loss making area. This is the higher break even. If the stock goes above this, we will start making loss and the loss will keep on increasing as it keeps on going upwards. Same thing downwards as well. So we just need a range bound market and we are trying to make money as time goes. Our profit is mainly time decay. This is what a short straddle is all about. Now let's see uh, a, an example here. This is of September 2025 monthly option. We start with 26 August because that's when the previous expiry. On 26th August, we are going to sell a short straddle. At the money is 24,900. So we will sell slightly much more round figure, which is 25,000 because there will be more volume. This is also at the money because this is very near to the money. We will treat it as at the money and we will sell a put option. We will also sell a call option. So we sold an at the money put and at the money call for the same expiry and we got a straddle chart. This is payoff chart. We will make the maximum profit if Nifty expires on 30 September at 25,000. During that 1 month period, Nifty can travel here and there, slightly up, slightly down, which is okay with us. However, it should not make violent moves. This is the market view, and this is when we will install. If we have this market view, we will install a short straddle. This is what we have just done. So this is a back testing software of Define Edge. We'll find out how it goes. Okay. This is 26th August. This is the position when we took it. And the maximum profit is 47,621. And here are the other details about the short straddle. No, it's a non-directional view and profit target. Ideally, we should not be waiting for the maximum profit. Here it is 47,621. 47,621. We should aim only for about 40% of the maximum profit because to expect that Nifty will Nifty will expire exactly at this 25,000 is not a reasonable expectation. That need not take place. Okay. So we should not wait for that. We should ideally be booking the profit when it is giving us some 40% or even maximum 50%. That's what we can do. 40% is quite reasonable. Most of the time we can get it. Let's see how it goes this month. One day over, the position creates a loss of 4,400 MGM loss. It is another day, 29th August, close to 3,000 MTM loss. We are waiting for some 90,000 or 20,000, near about 20,000. When we hit that, we can close the position. Why should we close? Because we know that there is significant risk to the downside and unlimited risk to the upside. So we don't want to keep this position uh, with this much risk for a long time. If we can get a reasonable profit, let's book it. That's what the policy should be. Another items to note: adjustments. Higher break even. If it hits the higher break even, what we should we do? And if it is the lower break even, what should we do? And protection. These are the things we will be covering in this video. Let's go and see how it goes. One more day. MGM profit of 4,500. You can see the price is going down. The profitability area is higher. The price is going down. Now the price is 24,500. 500 points, almost 500 points down. So we are still in a profit of 1,800. One more day for September. Profit increased to 7,000. Another day, the 10,000 rupees profit. One more day, 10,661. One more day, 12,000. One more day, 13,000. Another day, 15,000. 15,000. Again, 18,000. Now, 16th of September, we have 18,000 rupees profit. If you are happy with that, we can book it. Or another day, the profit came down to 10,000 rupees. Profit came also down because the stock is going up, the Nifty is going up. So it is almost going to reach our upper break even. Profit is getting reduced. One more day. Yeah. Because as the time goes, the time value goes down. This is known as time decay or theta decay. Because of that, profit is being generated. Now we are on the 22nd of September, 17,000. So what we really need is 19,000. One more day, 20,000. We can clearly book this profit because this is a reasonable profit. The position is giving us almost 23 days from the installation of the straddle, short straddle. Yeah, so we can book it. Let's see how it goes if we didn't book it. Another day, 27,000, profit increased. 31,000, 31,000. Again, profit came down to 26,000. The expiry is on 30 September, only one more day to go. 26,000. Okay, so this September 2025 shorts channel is a winning month. That doesn't mean that all the months during 2025 can be, all those months were winning. We don't know. We are not sure of that. We should check uh, some strategies or we should do some back test. By that, we can find out. In this situation, because our profit is reasonable, our expectation was reasonable. This this was a winning month for us. Okay, we'll check next month also. Reset. We will start on select start date that we will put as 1 October. And expiry, October expiry, 28 October. And the payoff It's also 28 October. Let's see how it goes. The position is 24,600 somewhere there. 24,750 is the at the money. So we will go to the round figure, which is 24,800, the nearest one. Sell a put and sell a call. So we created a short straddle here. 42,315 is the maximum profit. 42,315. We should be okay booking the profit when it gives us 16,000 or 17,000. Okay, let's see how it goes. One day goes 3,000 profit, 3,000. One more day, loss, MTM loss. Another day, as of 10th of October, we have 3,500 MTM loss, 4,000 loss, 6,700, I mean 7,000, 4,000, 14,000. It's crossing, it's going into the lost area, and we are on 17th October with not much time left because the expiry is on 28. We have 11 more days to go, but we are in those. We can do some adjustments because this is the higher break even. The price is going up. The break even is the strike plus the total premium. The strike is 24,800. We have to add 306 plus 258 to that so that we get higher break even, which is 25,366. Now the stock is more than that. Nifty is above that. So it is in a loss making territory and we don't know what's going to happen. So in that kind of a situation, we should do some adjustments, which is we should book profit on the put option. That is the first action. So the put is 24,800 put. We have to close. Take the profit. Here we are seeing a profit of 21,000 something. We should book it. 24,800 put. 20, 12.92 is the price. Now, last traded price is 20.35. So exit 20.35. We took profit on one leg, which is the put option. We only have one option, one position open right now. We are seeing a loss of 21,000 instead of 17,000 profit, which we wanted. But as we can see, after we close the position, the put option, if Nifty goes down, we will create, we'll be making a profit of 40,000, which is the maximum profit. That's a position, 40863. That's the maximum profit that we can make. If it goes down beyond this, we don't know whether that's going to take place. What can we do then? Because we do not know, and because this is going up, we are left with one option. We can either simply leave it like that and wait for the best, assuming that the risk is there. Knowing that the risk is there, we should always be knowing where the risk is. The risk is here. We should be aware of that. But if you can stomach that risk, then that's fine. Otherwise, we can reduce this risk to some extent by selling and at the money put option. This one at the money is 25,600 now. Sell one and collect the premium. It will be like this. the situation is like that. The profit is reduced. It's not showing here anyway, but we will be making or we will be reducing the loss. Instead of 21,000, if the stock is going down, we will reduce the loss. That's all we can do in this position which has gone against us. We will see how it goes. 20 October, 23 October, 24 October. This is giving us very huge loss. As of 28 October, we are seeing this loss in here. On the call option, we are seeing a loss of 72,000 rupees, from which these two puts together helped us to reduce the loss from 72 to 39. So this is the situation with short straddles. This is a short straddle which has gone wrong. This is for October. September was profit making. October happened to be a loss making short straddle. So that's all about short straddle. What we can do in uh, with the short straddle business. Sometimes we can use when we are selling a next month option. We can buy some protection in this month. For example, we can buy a put option near the lower break even. We can buy a call option near the upper break even so that to some extent we can compensate for the risk or the damage or the loss. That's all we can do. Also, we will get reduced margin in that kind of situation because we are defining our risk. Thank you for watching.